Natalie Trout. I'm a wealth advisor here at Elevation Wealth Partners, and welcome to the January 2026 market update. Today we have Don Annino from Lord Abbett joining us. His role at Lord Abbett, he's a portfolio specialist, and he also holds the Chartered Financial Analyst designation. He's been with Lord Abbett since 2006 and in the financial industry since 1995. Welcome, Don.
Thank you, Natalie. Appreciate you having me on today.
Yeah. First, let's look back at what happened last year in the markets. There was quite a bit of volatility, but it turned out to be a strong year.
Yeah, it was a great year. S&P was up almost 18%. Core bonds were up over 7%. That makes it the third consecutive double-digit year for the S&P. But it wasn't easy, right? We had a market-defining moment early in the year with the announcement of tariffs. That immediately set off and triggered concerns that the tariffs might slow global trade, could drive inflation here in the U.S., maybe even potentially put us at risk of a recession. But then as we went through the year and the extreme fears about the tariffs subsided, the markets rallied. Here's an interesting stat for you. There's a cliche in the market that says sell in May and go away. Well, if you would have sold in May and went away last year, you would have left 27.5% total return on the table if you would have not gotten back into the S&P 500 for the remainder of the year after the tariff announcement. So you're correct. It was a strong year for stocks and bonds.
Yeah, and that's a great statistic to emphasize what we tell our clients, which is just to stay the course. When things get tough, the best thing to do is nothing most of the time. One thing that we all felt over the past couple of years is the effects of inflation. And the Federal Reserve, they've been focused on reducing that. Their target's around 2%. How do we do last year in terms of inflation and also the economy as a whole?
Yeah. Well, at the economy level, both core inflation and headline inflation, both came down over the course of the year. They both, on a looking back on a full year basis, were down to about 2.7%. Now, in fairness, a lot of our lower income households are still struggling with the impact of how high inflation has been for the last several years, but we are making progress getting inflation more towards the Fed's target, as you mentioned, of 2%. We also think that there is room for the Fed to continue on that cutting path this year, and the yield curve is now more normal. As we mentioned, the bond market rallied last year, and the real inflation concerns, again, about the tariffs didn't materialize. So we're pretty positive on the progress that we're making on inflation, but it sure would be nice for it to keep coming down.
And to add a little background for everyone, what Don is talking about, a normal yield curve, that's an upward sloping curve. And that means that in the bond market, the investor is rewarded for a longer held bond, which is called duration, with a higher interest rate. So when it's upward sloping, this can signal economic growth. If it's flat or downward sloping, it can signal an economic slowdown. So what do you think the market has in store for us this year?
Yeah, Natalie. Well, it looks pretty good. I have to say, from Lord Abbott's perspective, the economy appears to be in good shape. We think another strong positive year with good earnings growth for the stock market. Some of that is the continued build out of the AI infrastructure business that we've seen driving the market for the last couple of years. But also we expect some tax benefits from the Big Beautiful Bill Act, where there's going to be tax incentives for companies to do more capital spending on plant, property, and equipment, and also capital spending on research and development. So we do think that this is a good environment. We think the yield curve is confirming the good environment that you described, and we have a lot of reasons we think to be optimistic for this year. Yeah, Natalie. Well, It looks pretty good, I have to say. From Lord Abbott's perspective, the economy appears to be in good shape. We think another strong positive year with good earnings.
Yeah, hopefully it'll be another good year in the market, fingers crossed. Um, In terms of the Big Beautiful Bill Act, something that might affect our clients, you feel it a bit more directly. It increased the state and local tax cap. That used to be 10,000 and now it'll be 40,000. So it's a big increase. So those of you who are paying a lot of interest on your mortgages, you could see a reduction in your tax bill. So speaking of interest rates, do you think we're going to see more cuts in 2026?
Yeah, it's always a tricky thing to try and predict interest rates, exceedingly difficult. But let's go with the data. The data per the Federal Reserve, the voting members would indicate the voting members of the Fed are anticipating cutting rates at least once this year. The market kind of vacillates back and forth between expecting two or three cuts, and that would be the Fed funds futures market. But I think the message for investors should be that the Fed is still, let's say, on the side of the market, right? Still more inclined to cut than to raise. The Fed believes that the neutral rate for the market is 3%, which gives them a lot more room to cut if they see appropriately, either to accommodate the market as they see inflation coming down or to support the market if they see some weakness in employment. So I would say right now the best estimate would be between 1 and 3 cuts for this year.
Yeah, the Fed likes to keep that tool in their back pocket. But one thing about the Fed is that we're going to see some change this year. They are the biggest driver of the economy, and we're going to see some change in leadership. Tell us about that.
Yes, it looks like Chairman Powell's term will be completed in May in all likelihood. You've heard a lot of, I'm sure, chatter in the news about potential successors. One thing we're keeping an eye on is to see who the administration chooses to replace Chairman Powell. While the chairman only has one vote when it comes to interest rates, there's still a lot of influence that the chairman or chairwoman would have on the markets, particularly through the forward messaging and the press conference. Um, the expectation is the appointment will be someone who's potentially more dovish. We're cautious. We don't necessarily want a new chairman who has a, let's say, an accepted dovish or even hawkish bias. We want someone who's going to be data dependent, data driven. If there's some question about um, Fed independence, that could create some volatility in the market. We really prefer not to have to go through that experience.
Yes, we hope not to. Honestly, I think it's pretty likely. There's a lot of fear around the change with the Federal Reserve leadership. So we build our own investment portfolios here in-house at Elevation, and we do utilize some of Lord Abbott's bond funds, which is why we've had them come join us today. And they specialize in bonds. Can you touch on a couple of the funds our clients might hold in their accounts?
Sure, Natalie. I would say right now, the Core Plus Bond Fund uh, should serve as a good counterbalance, a good diversifier from equities. As you mentioned, the yield curve is upward sloping. We have some more attractive yield now in high quality intermediate bonds. If something should go wrong with the economy or go wrong with the equity market, we would expect a high quality, longer duration portfolio, intermediate duration, would help counterbalance volatility in the equity market. From a yield seeking standpoint, because we are bullish on the economy and we are bullish on earnings, we think a short high yield strategy is appropriate because you are now getting compensated at a higher level, more yield. And because of our outlook on the economy and on earnings, we're very comfortable taking credit risk. And when you go shorter duration in a credit portfolio, you're emphasizing the credit risk, but you're minimizing the interest rate risk. So with the short duration high yield, taking advantage of the opportunity in the credit markets, taking a little bit more risk. And then the Core Plus Fund, you're going up in quality, not taking very much credit risk, but you're taking some interest rate risk, again, to balance any volatility that we might experience in the equity market.
Well, thanks, Don, for that background. Did you have any last thoughts to share with us today?
I would just emphasize what you said earlier is the importance of staying the course, not investing emotionally, making prudent assessment of the data that we see in the market. And if there is a material change in outlook for earnings, for interest rates, then we make, portfolio asset allocation decisions, but analyzing the information and trying not to react to the headlines because that can really move. Um, it can really move quickly, and it can be difficult to time it, right? Difficult to time, selling. And then, as I mentioned earlier, if you did sell, maybe you missed some of the downside, but then the question is always when do you buy back in? So we'd say the importance of staying the course and being more data driven as opposed to emotional driven is always prudent.
Absolutely, absolutely. And with our clients, we're looking at this every day here at Elevation. Fund companies we work with, like Lord Abbett, people like Don, they're looking at this every day. So sometimes you just got to put away the news and uh, be rest assured that we're looking after you and looking after your portfolios. So if any of you have additional questions, feel free to reach out to us. Otherwise, I hope everyone has a great 2026. Thanks, Dawn.
Thanks again, Natalie.